So today we're going to be looking at accounting analysis and trying to understand the quality of the reported numbers. Like last week, we're going to be using H&M as our example, and here in the worksheet that you see in front of you, you can see that you have the same kind of financial statements that we used last week, so the income statement, the balance sheet, and the cash flow statement. The new thing for this week is the accounting analysis tab, which is just pretty similar to last week. We're going to be calculating a few different ratios, but instead of these ratios being used to evaluate performance, we're going to be using these ratios to try to understand the quality of the accounting numbers. In many ways, these serve as kind of red flags to kind of indicate if there might be some form of kind of shenanigans going on in the background. So in case management is managing earnings and so on. So the first thing that we're going to be doing is something that's called revenue analysis. And again, just like last week, if you see a cell and you see a little red little kind of triangle in the top right corner, it just means that there's a comment there that's to help you calculate that ratio. But again, you can always just follow me on this video. So the first thing that we're going to be doing is revenue analysis. So revenue analysis is just trying to understand if there might be fictitious revenues going on. So management might be recognizing revenues when there's actually no revenues there. So one of the best ways to do this is by comparing the growth of accounts receivables and sales growth. So accounts receivables is obviously when you sell something on credit. So if, for example, your sales increase by 10%, but your accounting receivables increase by 30%, that's kind of a big difference because that means that even though your sales have increased somewhat, your accounts receivables have increased even more. And usually speaking, they should be increasing at about the same rate. So the first thing that we have to do is to basically calculate the accounts receivables growth and the sales growth. Now, because we only have figures from 2011 to 2015, the first growth figure we can calculate is 2012. So to do this, we have to essentially go to accounts receivables and look and compare the 2012 to 2011 accounts receivable. So I'm going to start the formula by clicking and pressing, I guess, the equal sign. And I'm going to put it within brackets because we're going to compare this year's accounts receivables to last year's accounts receivables and then dividing it by last year's accounts receivables. So first I go to the balance sheet. I choose this year's accounts receivables, so 2012 in column E. So it's in row 10. I'm going to subtract the previous year's accounts receivable in column D, and then close the bracket and divide it by the previous year's accounts receivable again in cell D10. Press enter and you get a negative 5.56 growth of accounts receivables. I'm going to drag it to the right to get to the, I guess, future years. Now for sales growth, exactly the same process, but in this case we're going to be using the income statement. So again, equal to, open up a bracket, go to the income statement, find the revenue for 2012, so it's in cell D6, then subtract the previous years in C6, close the bracket, and divide it by the previous year in C6 to get the growth factor. And again, we can see that it's increased by 10%, drag it to the right, and we see a bit of a, I guess, kind of different kind of progression. Now in row 5 here where it says the difference, it's just calculating the difference automatically for you. So I can see that it's decreased by 15%, so the difference between these two numbers. And then in 2013, I see actually a huge spike by 34% difference. So we can see here that accounts receivable has grown by 40%, whereas sales growth has only grown by 6%. Now, this is a bit of a cause for concern because they could indicate that the company is recording fictitious sales, meaning that they're essentially recording things on credit where there is no customer. And in the end, if they don't get the money, they have to write it off in the future. Now, in cases of companies like H&M, it might not be an issue because it's a huge company, they have good auditors. But if I were to see this in a small company, this would be a huge red flag. So usually speaking, when you see such a huge difference, you're trying to understand why it occurred. So if I go back to the balance sheet and I compare 2013 and 2012 for accounts receivables, I can see that it's grown by about $1 billion. So it's quite a big difference from 2.2 to 3.1. Now, the easiest way to figure out why this happened is to then look at the annual report. So in this case, we want to find the annual report for H&M in 2013. So annual report H&M 2013, just going to Google it. Usually it should be the first hit. So if I click on that, I'm essentially just going to look through the notes to see if there's been any mention to explain why accounts receivable have increased by such a huge amount. Now, usually speaking, when there is a huge deviation, there should be an explanation. But again, might not always be the case because technically speaking, in H&M's case, even though it's a billion kind of kroner change, it might still be kind of relatively small for that kind of a company. But still, just to make sure, I guess, to see what is actually happening, I want to see what they mention in the footnotes. So again, annual report is usually a couple hundred pages. So what you would usually have to do is to press Control F and then basically just search for receivable. There'll probably be a few different mentions of receivable, and we're trying to find the one that we're interested in, which is accounts receivable. So if I click enter to find the next mention, deferred tax receivable, that's not it. Current receivables, well, here I can see that there is our accounts receivable that has grown from 2.2 to 3.1 billion. There's no explanation here, but again, I just kind of go through and try to figure out if there's maybe other mentions of this accounts receivable change. So here up to the right corner, I can see that I have 53 hits of receivable. Now to narrow it down, I can just use what they're calling it accounts receivable to get a more kind of narrow I guess results. So now I have 12 mentions and I can just go down and go to the next one. First mention is just trying to explain the financial instruments of the company. It doesn't say anything about the increase. I'm not too concerned about this one. Go to the next one. Again, just talking a bit about the category in general, but not about the actual numbers. And again, it's basically just going through and making sure that it doesn't talk about what you're interested in. Once you find where it starts to talk about numbers, that's usually when you're interested in it. So here, I guess the 8th mention of accounts receivable, we can see that they state that accounts receivable is 3.1 billion and comparing it to the previous year figure, but they haven't really explained anything about why it actually increased. We can see here it says accounts receivables are divided between a large number of customers with low amounts per customer. The average debt was around Swedish kroner 2,100. So relatively speaking, I guess might not be a big deal, but it still kind of bothers me that they haven't explained it so far why there's been such an increase. And again, you're not always going to find the information in the footnotes because again, some companies, especially when they're very large, might see $1 billion increase as just kind of insignificant. So usually speaking, what we would also do in these cases is we would compare accounts receivables to sales. So in this case, I'm just going to compare the 2011 accounts receivables to sales by taking equal, going to the balance sheet, finding accounts receivables for 2011, and comparing it to sales in 2011. And again, I find that from the income statement. So it's 2.12%. If I drag it to the right, I can see it's going down to 1.83%, going up to 2.42%, and so on. So again, we do see that there is an increase here, but again, relatively speaking, it might not be such a big deal in comparison to the huge amount of sales that they have. But again, if this was a smaller company who I did not trust, this would be a huge red flag. And when you want to value the company, especially if you're buying the entire company, you would essentially ask their accounting department why this actually happened, and they would have to explain it to you. So the next thing that we're going to be looking at is depreciation analysis. Now, depreciation analysis is important because depreciation is one of those areas where you can quickly change the assumptions, and this will have a direct impact on your net profits. So if management wants to increase or decrease profits, depreciation rates is one of the easiest way to do it. So to see and make sure that nothing odd is happening here, I'm going to be looking at the depreciation rate. So I'm going to look at the depreciation expense in comparison to the property, plant, and equipment account to see what the percentage depreciation rate is. So here I'm going to take equal, and I'm going to get the depreciation expense from the income statement for 2011. So I'm going to go 2011. Usually it's going to be here at the reference item. So see, we have in row 71, so C71, we have depreciation expense. And I'm going to be dividing it by property, plant, and equipment in 2011. So again, column D. So here I'm going to find property, plant, and equipment. So I'm going to look at cell D22, click enter, and I get that the depreciation rate is about 10%. Drag it to the right, and I can actually see it hovers around 10%, so there's no red flags here. And again, if there's a huge change, just means that you need to go into the footnotes and figure out why has there been such a huge change in depreciation rates. Now, the next step is looking at the inventory analysis. Now, inventory analysis is used to find any kind of inventory that might have been avoided to be written down. So, say for example, you're a struggling company that sells computers, and you can't sell a huge batch of computers that you already bought from your supplier. In these cases, you should be writing it down as they kind of diminish in value, but a lot of companies just kind of try to avoid this because this will be an expense on their income statement and thus decrease net profits. So one way to identify these kind of situations is by looking at the inventory turnover, which is simply the cost of revenue divided by inventories. So again, in 2011, I'm going to go equal to, find the cost of sales in this case, or cost of revenue. In our case, it's in cell C8. I'm going to be dividing it by the inventories, which is on the balance sheet in cell, let's see, D13. Press enter and you get 3.17. Drag it to the right and you can see the progression. Now again, here we don't see anything, I guess, majorly wrong here. Usually speaking, when we have a low inventory turnover, especially of finished goods, it might imply that the inventories might include the relatively old products that might need to be written down. In this case, we don't see anything odd. Next step is the intangible asset analysis. Now, intangible assets is again one of those areas where it's very easy to kind of play around with the figures because again, intangible assets, the valuation of those are very, very hard because they're not physical assets that usually have a readily available market. So here we're going to be looking at two different aspects. One of them is intangible turnover and the second is goodwill to assets. So intangible turnover will tell us how efficient we are at using our intangibles to generate sales. So what we're going to be looking at is revenue divided by intangibles. So in 2011, I press equal, go to income, get revenue in, let's see, C6, and we're going to be dividing it by intangible assets in 2011, which we can find in column D in row 20. Let's see, total intangible assets, row 27 here. Press enter and we can see that we make about 106 kroners for each, I guess, kroner in intangible assets that we hold. Drag it to the right. And again, here we do see actually a quite significant decrease over time in intangible turnover. It basically just means that they're becoming less efficient at using their intangible assets to generate revenues. When this happens, it might actually imply that some of their intangible assets need to be impaired and in other words written down in value because they're essentially not as valuable anymore since they can't give us the same amount of sales that they used to. So again, because I see this, I'm now going to try and figure out why has this actually happened. So again, intangible turnover, I'm going to be looking at specifically the intangible assets to see what the account is looking like. So if I'm looking at total intangible assets on row 27, I can see that they've kind of increased by about $500 million, about 700 million, 700 million, and in the last year it's more than $1 billion increase in intangible assets, whereas our sales have obviously not grown at that rate, and that is why we have a decrease in that turnover. So again, we need to go to the financial reports. So in this case, this figure is from 2015. So we need to find the annual report for H&M in 2015. So again, just change the Google search. Usually the top result is the correct one. So I'm going to open this one up, and again, it's going to take a while to load, but essentially what I'm going to be doing is exactly what I did last time. I'm going to be searching for intangible throughout the annual report, look at and see what does H&M actually call their intangible assets, because sometimes it might be called intangible fixed assets or something else. Once I have that specific name, I can kind of narrow down my results, and what I want to find out is, can they actually explain why this increase has occurred? If there's a good explanation, then this decrease is not necessarily anything of significance for me. So in other words, that intangible turnover decrease is not a big deal. But again, it's all about the looking and seeing if they can actually explain what's occurring here. So again, we're almost loaded. And there we have the annual report from 2015. So in this case, I'm going to search for intangible first. And they seem to call it intangible fixed assets. And here you see what they're calling it, note 11, note 11, note 11. And here we can actually see what part of intangible fixed assets have increased so much. So brands have actually decreased, customer relations decreased, leasehold increased slightly, but we can actually identify that the large increase in intangible assets is from capitalized expenditure. And again, this is going to be found in note 11. So we can essentially just try to go down and see if we can find note 11. And here's note 11, intangible fixed assets. And again, usually speaking, we would have to go through the entire note, read it through, and try to figure out what is actually happening here. And again, here we see a very, very detailed overview of what's happening to the intangible fixed assets. And again, we did know that it was capitalized expenditure that was the big increase based on the information above. And again, what we're trying to do now is trying to figure out why has this actually occurred. So here I'm going to be looking, okay, so this has increased. I'm going to be looking at it kind of around the whole footnote and see where they talk about capitalized expenditure. So first they talk about goodwill, things like this. Here I can actually see where they talk about capitalized expenditure. So it says capitalized expenditure refers mainly to IT related investments. To a small extent, these were taken into use during 2013-15, whereupon amortization was commenced for those parts. Significant parts of the projects will be taken into use within 1 to 4 years. So effectively speaking, it seems that they've been doing some IT upgrades and investments, and this has been considered to be an intangible asset recognized in the books, and this is what's increasing their intangible assets. Again, if I were to see this in a small company, not a huge publicly listed company, this would be quite a big deal for me, and I would actually have to go to the management or to the accountants and actually be comfortable to know that these intangible asset valuations are actually appropriate. In this case, I would say it's probably not a big deal because, again, in relation to their total assets, their intangible assets are quite small. So the second part of intangible asset analysis is to look at goodwill to assets. Now, goodwill to assets is effectively something that is very important to look at when you have a company that performs a lot of acquisitions. In H&M's case, I know that's not the case, so goodwill to assets is probably not going to be a big deal. But effectively what we're looking at here is just comparing the goodwill account to the total asset account. So it's equal to, go to the balance sheet, find the goodwill account in, let's see, D28, and compare it to D35. and it's about 0.11%. Again, kind of negligible. But if you had a company that's been going on an acquisition spree, this figure might be 50, 60%. And especially when you have a downturn in the economy, a lot of those goodwill kind of assets will need to be written down. So it's kind of implies quite a huge risk in the long term. Now, the final figure that we're going to be looking at is the cash flow from operations to operating income. Now, this figure is quite interesting because it basically allows us to compare the cash that we get from our operations to our accounting income from our operations. Usually speaking, the ratio should be close to 1, about let's say about 0.8 to 1.1 is the kind of the normal range, I would say. And simply what we're doing here is we're taking equal to, we're going to the cash flow statement, going to cash flow from operating activities, so C17, and comparing it to our operating income, which is in C20 in our income statement. Again, in H&M's case, it's 0.85. Drag it to the right. I can see it's kind of increases slightly, increases more, decreases, and so on. So usually speaking, over the long period of time, let's say 20, 30 years, this ratio will be close to 1. From year to year, it might fluctuate from 0.8 to 0.9, 1, 1.1, or let's say 1.2. But if you see consistently that this ratio is, let's say, 0.5 or something like that, then that is kind of a significant issue because it implies that something kind of fishy is going on. That's it for this week. And again, once you calculate these ratios, just submit them on iLearn before the second session of this week.